Okay, so learning objective number 2, apply the revenue and expense recognition principles. This is an important, consistently important principle that we're going to be using over and over and over again. The revenue principle deals with two issues. The first one is when to record or recognize revenue. The second is what amount of revenue is to be recorded. The slide goes on to say revenue is recognized when the business transfers promised goods or services to a customer in an amount that reflects the cash or fair market value of the consideration that the entity expects to receive in exchange for those goods or services. Let's talk about it in simpler terms. Revenue is recognized when the business transfers promised goods and services. That means it is recognized when either you send the goods over to somebody, you send your goods that you're selling, or you completed a service. The slide goes on to say that the amount reflects the cash or fair market value of other considerations that the entity expects to receive in exchange for the goods or services. So even though we haven't yet received the cash yet, we're still going to go ahead and record the revenue. We're going to recognize the revenue because once we deliver the goods or deliver the service, we can expect to get paid. And the question becomes, well, what are we going to get paid? And we get paid based upon what the fair market value of what we're going to be receiving. So in most cases, it's going to be cash. But even though we don't get the cash initially, we'll go ahead and record the revenue, show that we've earned the revenue. We already have been exposed to it a little bit by showing that we can have an accounts receivable. So the receivable is what we recognize in addition to the revenue. So the important thing here to remember is that revenue is recognized when it is earned. The expense recognition principle, this is the other side of the income statement. The expense recognition principle says we must identify all expenses incurred during the period. We'll measure the expense and recognize them in the same period in which they relate to revenues earned. So what we're focused here, let's go back to the revenue. Well, first we want to know, well, how much did we make during the year or during the quarter or during the month, whatever it is, how much did we make? And then once we have that, we need to know, well, how much did we incur for that same period? Now, going back to, well, revenue can be recognized even though you didn't receive the cash, the same concept applies when we're talking about expenses. We should recognize the expense when it has been incurred, even though we haven't paid for it. We haven't paid in cash yet for that service or for those goods. So the easiest way I can explain this to you is let's assume we start a business today. Let's say I ask all of you to take over this business. You're going to start a business starting this morning. In fact, it just started this morning. You opened up a business and I invested a lot of money into this business, right? You opened up the doors, you have all your supplies ready to go. Let's pretend it's an accounting service. You got all kinds of supplies ready to go. You had computers on, ready to go. And then it turns out that as soon as you opened up the door, the phone started ringing and a whole bunch of clients came in and brought tax return, financial statement. They brought stuff in. Well, you were so busy throughout the entire day working, trying to make money, right? You were so busy throughout the entire day that by the end of the day, you have completed services for at least 5 customers. And the paperwork is all ready to go and setting them up at the reception desk so that it can be picked up. Everything is ready to go. You finished it towards the end of the evening and nobody had a chance to call the client. As a result, it was late, everybody's tired, ready to go home. You went ahead and shut down for the day, figuring that in the morning when you come in, you'll call the client. What's to note here? You guys worked all day and you created or generated enough services that when the client comes in to pick up their information, their tax returns, their financial statements, they should be ready to pay. However, you were so busy, you didn't get a chance to to call a customer. But I came in the evening, and as the owner, I'm interested to know whether or not you made any money today. So the first thing I do is go look into the cash drawer. Maybe there's a drawer with a little pouch in there for cash that's been received during the day. I open it up and I look, and there's the pouch is there, unzip it, and there's no money in there. I look on the cash register, nothing has happened. My question to you is it fair that I judge your performance, the performance of the staff that worked all day? Is it fair that I judge your performance based upon the cash? And if so, then you guys are all fired because there's no money that came in today. You finished a lot of services for the day, but no cash came in. Is it fair that I fire all of you today or the next morning when you come in because no cash? And the obvious answer is no, it's not, because you actually worked, you produced, you created revenue. We still haven't received the cash yet, but from an ownership perspective, I need to understand that. I need to be able to see that you actually earned some money, and with the expectation that that money is going to come in. So that's the issue associated with revenue. Now let's take the same concept associated with expenses. Now I pulled out the checkbook and I noticed not one check was written, no cash left for the day. Nothing happened. It's almost as if you weren't here all day long. It almost seems that way. The question is do I have any expenses? And the obvious answer is yes, of course you do. What expenses do you have? Well, you had some salaries and wages that we have to pay, not today, maybe not even tomorrow, but when payday comes next week or the following week, we're going to have to pay those. But you incurred those expenses today. If I had to let anybody go today, I would have to write that check out, right? I owe the money as of today. The utilities, the lights were on, and so the meter was running. Yeah, I'm not going to have to pay for that until next month, but I've got to figure out a way to be able to account for how much utility I used for the day. Supplies, you used up supplies. All day long, you used up paperwork and pencils and papers. And I mean, you used a lot of stuff up during the day to generate that income. And the question is did I have any expense? Well, if you look at the checkbook, it kind of implies no, you didn't. You had no expenses because you didn't write out any checks. But the reality is you did. You have wages, utilities, supplies, rent for the day. There's a ton of expenses there that have been incurred that have not quite been paid yet. Accounting, using accrual basis of accounting, the objective is to be able to show revenue that is earned for that day and then match it with expenses or the resources that you used to generate that income for that day. So I want to know, how much did you generate by billable? That, you know, I see that now. I notice there's work on the table there that's going to be picked up. So I need to add that up. And let's say I add it up and it turns out to be $10,000 for that day. No cash came in, but you have $10,000 of work that's been finished, that's completed. Okay, that's revenue that was earned today. Now, in terms of expenses, I need to figure out, well, since I made $10,000 today, how much in terms of expenses have I incurred for today? Salaries, rent, supplies, utilities. I know I didn't write a single check out, but I need to figure out a way to measure those expenses, because based upon the revenues that were generated and the expenses that were incurred, I can then figure out whether I made money for that day. Now take that concept for one day and let's make it a week. Take that concept for a week and let's make it a month. Take that concept for a month, let's make it a year. And so what we're trying to do is figure out within that period we're trying to measure is how much revenue has been earned for that period. Now, since you're measuring a whole year, then chances are some of that money that you earned at the early part of the year, the cash has already come in as well. So cash follows with the revenues earnings. But it doesn't necessarily mean that all that revenue that you're going to be showing for that period was actually received in that period. Some of it may have been received in different periods. So we're trying to figure out how much revenue has been earned for that period and how much expenses have been incurred during that same period of time. And that's what we're trying to do, is we're trying to match the expenses with the corresponding revenue so that we can really make a determination as whether or not I made money in that day, in that month, or in that year. Net income is determined by taking revenue minus expenses, and that will equal your net income. You could have a net loss. Net income in the first example we have here shows that your revenue was $1,000. You're subtracting $800 of expenses for that same period, and you have net income of $200. Looking at another example, you could have a situation where your income was only $700, or your revenue was only $700. Your expenses were $800. And so in this period, you're going to be showing a net loss. Income is when your revenues are greater than your expenses. A loss is when your expenses are greater than your revenues.